What is life insurance and who needs it? Let's break it down on this episode of the Hawaii Retirement Show. Hey, welcome everyone to this episode of the Hawaii Retirement Show. Super excited to have you talking about life insurance. But before we dig in, Jason, how are you doing? How was your week?
Doing good. Week's good, trucking along here. It is we turned the page. We're in August now, right? So school's right around the corner. Had a good weekend. So I had a little barbecue at Magic Island yesterday. It was really nice weather.
Yeah.
Really good day. How about you?
Yeah, no, it's been a great week. Excited for school to get started, to be honest. My daughter gets to go off to school and we have a little bit more time to have her at school.
Right. I think there's a lot of parents that are I don't want to say anxiously waiting the start of school, but I'm sure.
Yeah, it was really funny. I actually was talking to a teacher, and she was like, it's always funny. Parents are super excited when school starts, but us, we're just like, oh no, another year.
Yep.
Yeah, but anyway, just jumping into this conversation, we're excited to bring in what is life insurance and who needs it. And really, Jason, just to kick things off, let's talk a little bit about, why someone might need life insurance.
Yeah. So this is such a big one. So why somebody needs life insurance? From my perspective, life insurance is there to provide some sort of economic benefit to sustain loved ones or people who are depending on your economic contributions to the family or whatever that might be. Now there's other reasons too. For instance, passing on generational wealth. That could be, and there's some really fancy things you can do with what they call infinite banking, and then there's ILITs where you're putting life insurance in a trust and all. But for most of our listeners, the way I see it, life insurance is there to kind of if one spouse goes down, there's this policy that provides and helps the kids and the remaining spouse kind of get through a period of time with some economic security. That's how I would kind of sum up life insurance and who needs it. What do you think?
Yeah, to me, this is always a little bit of an uncomfortable conversation because you are talking about potentially a loved one dying in this case and receiving a benefit because of that death or because of that passing away. But it's such an important foundation to anybody's financial picture. So to me, just to kind of reiterate what you said, if there's any financial benefits or financial loss, right? That is, if someone was to pass away, so maybe your spouse works, and if you have kids, you want to pay for college, all these things that are lost because of the income loss would just make life insurance so much more important. You can talk about those fancy things like generation passing on and all that kind of stuff. But really,
Right.
at the end of the day, most people have significant financial pain with a premature death. And so just for me, just kind of how I look at it. So, I have a wife and two kids.
Right.
If I was to pass away prematurely, life insurance, which I do have, would be such a critical part just for my safe, like my mindset and my, like the way that I think about it, because I know that my wife wouldn't just have to go run off and have to figure something out, maybe get married or whatever, quickly because of, just needing income. So to me, that first foundation is like having life insurance because somebody in your life might have a financial need of yours. And I think,
Sure.
and maybe another, just to think about maybe who doesn't need it yet, because I would say yet, because I think at some point everybody might need it. But so for me, I can think about it like, maybe you're young and single and have no debts and nothing that's kind of tying you to anything. Not saying you're not valuable, your life is valuable, but as a financial component, maybe not yet.
Right. No, that's good. And there's a lot of different ways you can look at the value of life insurance. And then so I guess just jumping into kind of some components of life insurance. So essentially what somebody does who's seeking a life insurance policy, let's say they identify a need, they want to protect their family if they pass away, something happens, whatever the reason, they identify a need. They're going to go look for a certain type of life insurance policy. So I think we're going to get into kind of the four basic ones. And what they do is they identify, typically through an insurance agent or an insurance company, a policy that they want. They're going to apply for it. And then there's underwriting, and the underwriting is kind of the screening. They're going to check out certain things. Maybe it's your health, your economic, your credit, or whatever it might be.
Family
Right? They're
history even too.
family history, right? They're going to check out some things, and then you can qualify for a plan, right? And then once you qualify for a plan, you accept it, or whatever happens there, and then you start paying premiums. And these premiums are kind of your financial obligation to pay whatever the frequency might be. Typically it's monthly, right? You're paying a monthly premium in exchange for this promise. So the insurance company has made a promise. As long as you pay this, then we promise to give you this benefit. And that's usually outlined in the policy. Now, when premiums stop, there's a few things that can happen, and it varies depending on the type of insurance. But then a policy could, what they call, lapse, right? Potentially, and potentially just terminate. And we'll get into with cash balance within a plan that can be used to keep it afloat. But I'm just trying to give a gloss over, kind of high level, what the process and what we're talking about. Anything you want to add to that there?
Yeah, I mean, for this point, with regards to just that policy process, working with, different clients in the past, having multiple options available, it's important to have a good medical exam, if you will, assuming you have to take one, because you get rated, right? So most insurance companies will rate you, whether you're standard health or better than standard or worse than standard. And the only thing I'll caveat here too is, they do look for, like, are you a smoker? Do you drink? There are different scenarios that they look at as potentially a negative on your health.
Right. And so that can affect the amount of your premiums, right?
Correct.
And maybe so that's why, like, no two people are like, if me and you applied for the same term life insurance, we might be offered different, maybe the same amount of coverage, but at a different premium depending on our health, right?
Yep, absolutely. Absolutely.
Okay, so let's dive in. So the four main ones we're going to kind of gloss over again, keep it high level, is term life, whole life, universal life, and variable life. Those are the four we're going to kind of just touch on to give our listeners a general idea of what each of these are. So do you want to start us off with term life? Give us a little rundown of what that is.
Yeah, I'd love to. So term life is as it states, so it's for a period of a term of your life, right? So in a lot of cases, term life is typically like a lower premium because of its duration connectivity. So, like, you could get like a 30-year term policy, right? So, you pay premiums for 30 years. And it's like a use it or lose it type of a scenario. And then, you can get, 20, 15, 10, all the way down to 5. In essence, you're covering a period of time of your life, right? So if you think about this, like, I'll just use me as example. So I have 2 kids. I got my life insurance, when I was in my 20s, as married and kids. And I got it for a period of time because that's the highest need of time, in my opinion, to have coverage. Because, once my kids become older, maybe that goes down. But basically what a term policy is it covers a period of time. You decide when you get the policy how much death benefit you want, right? So in some cases it might be, it ranges from as high as you want it to be. But typically you're going to select a death benefit. You're going to select a term period, and then they're going to give you a monthly or an annual expense to that policy. And if you were to ever stop paying that premium, like Jason mentioned, or you're able to just, stop altogether, it will terminate and it won't continue. And it doesn't build any other benefits other than just, basically use it or lose it, right? So if you pass away, your beneficiaries get to use it. If you don't pass away, you'll live past the premium, or excuse me, you'll live past the term policy, which is also honestly it's great, because you're still alive.
Right, right.
Sorry,
Yeah,
anything you want to add to term?
no, no, and I just like, so let's say you take out a 20-year term, and let's say you get to year 15 and you're like, you know what, I'm financially secure, and I got my family taken care of. You have the option. You could just stop and say, I'm going to stop paying the premiums, and I'm just done. You don't need to finish out that term. Now, I'll caveat that with sometimes the insurance companies will offer you to I forget the term, but
Yeah,
you're
you
gonna
can like
move,
convert it.
convert it into, I
Yeah,
don't know why I couldn't come up with just convert, but
it's okay.
convert it convert it into a whole life, a permanent, what they call a permanent policy, right? So
No,
that's
yeah.
that's one advantage to kind of if you keep it in force, obviously, other than providing the economic security and peace of mind,
Yep.
there is those opportunities.
Yeah, and that will depend on the insurance provider you have. Most of them they kind of bring that standard, but I think that's a great transition point to like to whole life, right? So
Right.
so Jason, why don't you break down a little bit about what whole life is and how it might differ?
Right. So pretty much just think of it, it's just the opposite of term, right? It's not just for a specific period, it's for your whole life. Hence the term, right? So it's the idea is you're going to continue to pay premiums and you get this coverage for your whole life. Now, one unique difference is whole life policies typically accrue a cash value. So there's like this it's hard to describe. So you're paying for your premiums for your death benefit, but at the same time you're watching this cash value or balance in your policy rise as well. And that cash value, it accrues at usually a fixed interest rate, and it can be used for a couple different things. You can actually make withdrawals from that cash value. You can use it to cover premiums at times for the policy if you can't. So that's kind of the two primary differences. Is one obviously whole life, one is for a term, and then there's that cash balance aspect to the whole life policy that we see.
Yeah. And for me, I mean, one of the like you said, like one of the biggest differences, term, it's a period of time. You can outlive it. And let's just be real, we're all going to pass away at some point in time. So a whole life policy will be used. So traditionally, a whole life policy comes with a higher premium
Right.
because at some point in time, you will pass away and the insurance company will have to pay out that death benefit.
Yeah, and those premiums, I mean, so there's a couple different ways in which they can structure them. There's like level, what they call level premiums, right? And then there's ways where you can, your premiums are higher early on and they taper off, and vice versa, right? You can have lower premiums that eventually become higher later on. So there's a couple different creative ways that they can structure the premiums, depending on what you're looking for, really.
No, it's a good point. And I mean, one of the ways that they do that, just so people understand, part of why it does accrue cash balances is because you're essentially like overpaying for insurance in the beginning.
Hmm.
And then as you age, as it should, insurance gets more expensive, right? So now it's starting to, cost more to cover your life because, 60s, 70s, and 80s potentially, right? In this case, that the risk is higher and higher, higher because you're closer to that inevitable passing away point. So then that's what that cash balance is for, where it kind of like if you continue to pay level premiums, it starts to then take money out of that cash balance to pay for those premiums in the future.
Right, right. And that goes into I'm always fascinated by the actuaries that figure out, the lifetime tables and statistics of, the chances of, this person, a male at age 28, compared to a female at age 60. They got this stuff really dialed in.
Yeah.
And I mean, and that's how insurance that's how they're able to function, right? Is they can't be paying out to everybody the full amount, right? That's the whole thing with auto insurance, right? Is the people who don't get in accidents kind of subsidize the people who do, but you still need it in case you're that person that gets in the accident, right?
Absolutely. Yeah. I think auto
Okay.
insurance is a great analogy, but sorry,
Yeah.
continue.
No. I was just gonna say we'll move on. Universal life. So universal life is quite similar to whole life. The primary difference that kind of stands out in my mind is the flexibility in premium payments. That's kind of the simplest way I break it down, in that you're not tied to a specific um, premium amount, and as such, your death benefit will reflect that. Um, does that's the simplest way I can kind of explain it? Do you think you have anything you want to add on to that?
Yeah, no, I mean, I think, there's a lot of it starts to get as we gravitate towards these different ones, they tend to get a little bit more complicated, right?
Right,
So term
right,
is pretty straightforward. Whole life is a little more straightforward, and now we're getting because there's different things that you can add. There's different things
Sure.
that you can, ability to pay, and those flexibilities create, potential positives or negatives on these types of policies.
And there's tax implications to a lot of this stuff that we're not going to get into for this episode. I'd say the furthest we'll get in for tax implications is for our listeners to know that death benefits are received tax free. So when if you have $1 million whole life or term policy with a $1 million benefit, the beneficiary of that policy is going to receive that full $1 million. It's not taxed.
Yep, 100%. That's one of the beautiful things about life insurance. Obviously, the not beautiful side is someone has to pass away, but these are resources. These are funds that become available to you as tax-free money.
Right. Okay, anything you want to add to universal life other than, you get the flexible premiums and that reflects in the amount of death benefit before we move on to variable life?
Yeah, I mean, for me, like, just know what you are trying to achieve, and I'll say that all the time when it comes to insurance. But yeah, I think that's good for now. So why don't we just move into variable life? Why don't we kick it off? What are some of your thoughts about variable life?
Yeah, so variable life kind of takes it a step further in that now we're kind of incorporating investments into life insurance. That's the most basic way I can sum it up, is that there's going to be these sub accounts that are invested, and their performance kind of ties into your life insurance policy.
Mm-hmm.
Um, you're mashing insurance and investments together, and you're getting a variable life insurance policy. And as such, these policies, they require the insurance agent to actually have a series 7 or just different licenses
Mm-hmm.
to sell, because there's the investment aspect to them.
Yep.
That's the main one that stands out for me.
Yeah, no, exactly. I mean, as it is variable, now you start to put in variable components. Investment performance does either create significant potential to, premium payments, or a significant risk on, future premium payments.
Right.
Yeah.
And
Yeah.
then no, go
Go
ahead.
ahead. No, I was just gonna say, any other thoughts on that?
No, I think we'll leave it there. And like we said, we'll probably circle back, because these are so complex that variable life, universal life, and even aspects of whole life. Term is pretty straightforward, but we'll probably circle back to get into a little bit of the nitty gritty and the details of these policies. But I think that's a good place to leave it there. But before we wrap up, still got some things that we want to tell our listeners about, and one of them is riders. And I think you mentioned it earlier, but what they call riders are these little add-ons that you can tack on to your life insurance policy, such as long-term care insurance is a popular one. Help me out. What are some other good riders
Yeah, I
that
mean, some
tack
different
on?
riders are like, some of them have like, income riders, or they have even like premium like repayment types of riders. I
Sure,
think
sure,
the,
sure.
the critical illness or like disability type of riders are in there as well.
Right,
So
right.
yeah.
Yeah, and those are interesting in that, let's say you get disabled and you're unable to work to make money to pay the premiums, there's certain riders that allow that, the policy stays in place, and there's all these different riders. There's quite a few, but with each of these riders, it comes at a cost, right? So you're adding a bell and whistle to your policy, and that might be a great thing, but there's going to be a cost associated with that, which there should be, right? I mean, you're adding an extra layer to your policy. So
Yep. No, absolutely. And that's a cost that you have to weigh. That's a cost that you have to decide if it's something that you're interested in having, and what the overall goal is for that policy, right? Is it just for life? Is it just for a death benefit or a death, event, or is it for other things as well?
right. And then I guess closing us out here, you want to talk about kind of the ways people can, so for our listeners, kind of an actionable idea of, okay, how much life insurance do I need? How do I figure that out? Right. Okay. I have my family here. I'm the primary breadwinner, or maybe my spouse is the primary breadwinner. And how do I figure out how much I need?
Yeah, I love this question. And, there are many trains of thought, but the two ones that I kind of subscribe to, if you will, is going to be just kind of like a flat 10 times earnings, if you will. So let's just say, for example, you make, $70,000 a year or something like that. So a basic number would be something like 700,000, right? So that's like a simple, not really complicated equation. But it might not be the exact amount that you need, because the other one would be like a needs analysis, right? So to what Jason was saying, like if you have a spouse, if you have kids, if you have a mortgage, those are all things that increase your need, right? Because theoretically, paying for college in the future, there's premature death, income loss, maybe college needs to be paid for, mortgage and stuff like that. The only other thing that I would add there is not devaluing your homemaking spouse, right? So if you have a spouse that stays home and takes care of the kids, you have to imagine what's going to be lost in the event of a premature death of that spouse, whether it's husband or wife. Doesn't matter which one it is, but
Sure.
taking care of the kids, having those types of needs met, there's a loss. There's a significant loss there, right? So my thought is there's always a reason why, if there's parents or there's children involved, it might not be the same death benefit, but there is still a need that would be lost.
Yeah, and just the only thing I have to say is rules of thumbs are great, but rules of thumbs are meant to be blanket kind of, obviously, right, by nature, and we're also unique when you start to really peel back the layers. In many ways, we're all the same, and in many ways, we're all so different, right? Yeah. And so, those 10x income and the needs analysis, there could be a lot of other things in play that change that calculation for yourself. So it's individual.
Absolutely. And at the end of the day, that's 100% and always the most accurate answer.
Right.
Which is why it's important to work with somebody who knows your situation, who knows what you're trying to achieve, and to make sure you have the appropriate coverage.
Sure. All right. Well, a hot topic out there right now is this infinite banking stuff, but I think we're going to table that, and maybe we'll circle back to that on another episode. But anything else you got for our life insurance episode today?
Yeah, no, I think this is a great starting point. Whether you need it now or whether you need it in the future, that's something to make sure you know. Just know that there's lots of intricacies with each of these policies types, and we'll break those down in a future episode. So yeah, Sounds with good. That, Jason, appreciate your time. Thank you so much for listening, and hope you guys have a great day.
The opinions and statements presented on this show are for general information only and are not intended to provide specific advice or recommendations. Never make any investment or financial decisions based on information offered on this show without first consulting your financial, legal, or tax advisor. All economic and performance information mentioned on the show is historical in nature and is not indicative of any future results. All indices mentioned on this show are unmanaged and cannot be invested in directly. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Lastly, all opinions expressed by Jason Cutitta, Paul McWilliams, and any guests on the show are solely their own opinions and do not reflect the opinions of or are endorsed by ToBA Financial or Inspire Advisors. For Jason Cutitta, investment advisory services are offered through ToBA Financial LLC, a registered investment advisor offering advisory services in the state of Hawaii and in other jurisdictions where exempt from registration. And for Paul McWilliams, investment advisory services are offered through Inspire Advisors LLC, a registered investment advisor with the SEC.